Hey guys, welcome to another week, the 12th week, in fact, of This Week in Investing and Finance. It is July 9th. Happy 4th of July. Sunday night here, as usual. It was a very quiet week in finance. Most asset classes are pretty quiet. Of course, we can never predict when volatility will rear its head, but volatility at least is somewhat low, but I'm not sure if that portends anything. So everything's sort of the same as it was last week. Really very little to note. I noticed the yield curve steepen again, which I think is a good thing, and there were some other economic indicators that were kind of good. We're in a kind of Goldilocks environment. Growth isn't too fast, it's not too slow, it's kind of just right. I've been hunting for new stocks to buy and short, but have been preoccupied with some other engagements. So in any event, we'll keep kind of looking. One of the things that I thought I'd do is talk about quantitative investing. So there's a lot to do in quantitative investing, and I think a lot of people sort of get a little bit scared of quantitative investing. And what I thought I'd do is create a really basic algorithm that I'll show you guys kind of how to do. And what we can do is maybe even collaborate a little bit on it, where we can sort of create and backtest some of these algorithms and sort of see where things come out. This is a very kind of, how should I put it, basic algorithm that I still think is kind of neat. And it's I'd say 80 or 90% quantitative and 10 or 20% fundamental. I don't like, there's sort of two ways to think about quantitative investing. The first is kind of microstructure quantitative investing, which has to deal with very, very short-term trading. Some people call it high-frequency trading. I don't like that kind of quant investing. I don't think anybody should really do it, to be honest. It's kind of becomes more like a video game or a structural inefficiency. You can go buy data for microseconds, advantage above your competition, and try to out-trade them in that kind of environment. I don't think that that's a really wise thing to do. It becomes an arms race, and I think it has questionable legality. I like the short term to intermediate term, not the ultra short term, but the sort of intermediate term quantitative investing. So I actually like about a 1 month time frame. And I think that that's sort of where the future of so-called quantitative investing, or statistical arbitrage is another word for that, is. And there's a sort of a pairs trading methodology taught to me by one of the founders of D.E. Shaw, and I'll share a little bit of it with you now. And so in essence, pairs trading involves going long. I guess I didn't explain that here. But pairs trading is going long one stock and going short another, so that you're, market neutral. So a good example would be, going long a pharmaceutical stock and going short another different pharmaceutical stock in the same amount would be a pairs trade. And what you're trying to do is you're trying to gain some difference between the two. Obviously, you hope your long goes up and your short goes down, but at the same time, there's some expectation that maybe both stocks will go up, but your short will go up less than your long, and you'd make money, or vice versa, that both stocks might go down if the market goes down, but your long will maybe be a little more insulated than your short. So there's a few different ways to do it in terms of pairs trade is a form of a hedge. It's not exactly the same. Hedge can be kind of any kind of thing that mitigates your downside, but a pairs trade is being long and short, sort of generally speaking, not always, but generally speaking, similar companies like a food company or a pharmaceutical company having them both long and short. It's different from hedging in the sense that you could hedge a portfolio, say, with options, whereas pairs trading is, if you're long Boeing and you're short Lockheed, that's a pair. They're a natural pair in a sense. So in any event, what I like to do is take an industry like, say, pharmaceuticals, something I know relatively well, and go back as far as I can with data and rebase all the prices to one. And so the prices change based on that rebase. So I can show you a little bit of what I mean. Let's see here. Okay. So if you go back down here, this is 2010, so it's about 7 years ago. This is the Merck price for 2010, and in 2010 terms, the stock price is $33.71, but it doesn't really make sense to pick an arbitrary number. So I'd rebase it to 1, and then you can see that the stock price changes according to this rebase, and you have it at $1.87. So if you change all of them to $1, you can make some comparisons, and then you might want to also roll. I do this rolling rebase, which is another sort of way to do it. So this is every 30 days, in essence, it sort of resets, so you get this different rebase. So you can do this a few different ways, and if you normalize them enough, what you do is you'll end up being able to compare them. So say the relationship between Merck and Lilly or Merck and Pfizer. And the reason this is really interesting is that it makes sense that a group, an industry, should have all the same benefits and all the same drawbacks, and that Merck might outfox Pfizer at one point, but all the same resources are available to all of these companies. And obviously, if a company takes a dramatically different strategy, like it says that, well, we're not going to do, we're only going to focus on cancer, that would have been a very handsome strategy to take 10 or 20 years ago, or 15 years ago. And so that company may stand out, and there's ways to sort of control for that kind of change in the nature of a company. But in general, a group of companies in any one field sort of have the same they have the same resources available to them. And while one company may do better than another, you can argue that delta is going to be due to chance and not really due to something that you can predict. So the reason this is interesting is that if it's true that an industry, that the inter-company differences of the industry components will travel in a band, then one can hypothesize that a reversion to mean phenomenon will take place. In other words, that if one stock of the industry, say Eli Lilly or Merck, outperforms another stock, say Bristol Myers or Pfizer, that it's likely that those relationships will collapse again and the mean will revert. And this is a very basic quantitative concept called reversion to mean, or mean reversion algorithm. And it was popularized, I think, by D.E. Shaw. Again, companies like these, Renaissance, D.E. Shaw, Two Sigma, etc., are control their algorithmic trading secrets very carefully. But I know this is a pairs trading phenomenon for equities that D.E. Shaw does quite a bit of. So what I did is I took the rolling 30-day rebased relative performance, and what I did with that is I tried to take a reversion to mean pair trade at -2 and +2 sigma. So in other words, if these are two of the relationships, if you can see here that the relationship blows out to the upside, that I would take the other side. So if let's say this was Lockheed Martin and Boeing, I would the relationship between the two is a ratio that centers around 1. Then in essence I would go long Lockheed here and short Boeing, and maybe here I'd go long Boeing and short Lockheed, and back and forth. And this is really interesting because this is much easier than so-called technical analysis, which I don't really think is a real phenomenon. This is sort of a fake phenomenon that we humans like to make things simple. But you can see that this is a really reliable relationship, that there's always this reversion to mean without a blowout. When I say blowout, I mean something that is such a big delta that it will blow you up if you have the trade on. And so these are totally different signals, and these are really good signals that you can take and almost certainly make money on. So I did this 2 sigma strategy. What I found was that I got about a 20% IRR, which is pretty incredible, but maybe even more incredible was that there's this scalability that comes with this type of trade where you can do $100 million trades here and make money repeatedly, and your bite size is relatively small. So I thought it was a pretty cool algorithm. I encourage you guys to share your algorithms with me. You can email me. I share my email at the end of the program. But the most important thing I think in quantitative investing is that the algorithm has to stand to reason. That just because you find a correlation, if there's no causality or no sort of implicit causality, then you're going to have a very hard time justifying putting real money behind the trade, because you really have to start with the theory and then build your algorithm. I think a lot of people start with the algorithm and then pray there's some theory attached to it, and I really don't think that works. So, if anyone wants to sort of play with some of these relationships and some of this data with me, you're more than welcome to email me and start up some quantitative investing research with me, and be very happy to write algorithms with you. Anyway, moving on. There's a stock that I think is a pretty good short called Ironwood. This is IRWD. It's a $2.5 billion company. They have one drug for various GI maladies, and I think that IBS, in other words, irritable bowel syndrome. And the company has got about 600 to 700 million in revenue. They share that with Allergan. The company reports about 250 million in revenue, and they're unprofitable. So they're at scale and they're still unprofitable. I actually assume that they will get to $1 billion or more in revenue, and I still think the stock has 70% downside. They're fighting hard to replace Linzess. I'll show you the model here. So I have Linzess growing to say $1 billion, which is what they're projecting. Although I don't think it'll get there, to be honest. And then you have a 2024 patent expiry, so they're going to try to replace Linzess with another GI kind of acting later in the GI acting product, which I'm not sure will work. And then they have a bunch of other crappy drugs. I have their gout drug becoming a $100 or $200 million drug, which I also don't think it'll happen. So I'm being pretty generous here, and I get a $6 stock. The stock's at 17 right now, so I'm pretty excited about this short. It's a small position in the portfolio right now, but I'm going to increase it. I think this company has a lot of problems. They are betting on the primary care model of pharma, which is sort of broken and has disappeared. And they're sort of doubling down on it. They want to make a GERD drug. I think it's a really messy company. And again, it's shocking to be losing money every quarter at this kind of scale, where they've actually done relatively well with Linzess. So it just kind of shows you that they kind of have a broken model, I think. So in any event, I think Ironwood's a short. Someone asked me for some more detail on this, so there's a little bit more detail on Ironwood. So the month just got started. There's some interesting moves. Obviously, Beijing, which is a fun name to say because it's a Chinese company, and the pun is there with Beijing. That company had some big news with Celgene. We'll talk about that in a second. Not a lot else going on. Again, it's pretty quiet. It's a good time to sort of catch up on lots of different things. The summer is generally a quiet period. Q2 did end, so you should expect Q2 earnings in the next few weeks, and then pretty much everyone will go on vacation, but we'll see how Q2 went for most of these companies. I added to my current opinions, again, I've got Global Blood, GBT could be a good long, so I'm taking a look at that. Prothena and Fibrogen could be good shorts. Ironwood is a good short. Alchemies is probably a good short. The secret short involves a hidden camera, so we're trying to get the hidden camera operational, so stay tuned. We want to make sure that the secret short is as exciting as as you might think. So we'll sort of see. And you're free to disagree with me on any of these things. Again, the portfolio is about an 83% win rate right now, so caveat emptor, I don't think I'll stay at 83%. So here's the portfolio. I don't think there are too many services like this where people show their entire portfolio to you, so I think and track the progress of it. So I'm happy to provide this service to you free of charge. And so, as I've mentioned many times, Alexion is one of my favorite longs, and this is, again, really important to understand. This is a risk-adjusted long. Everything is risk-adjusted. You have to understand that something with low risk has to increase its weighting in your portfolio to accommodate that risk, where something like Avexis, I could argue very easily that Avexis is actually my biggest long position, because Avexis is such a risky company that even a 3% position in Avexis is much riskier than Alexion at twice the amount, because at the end of the day, Alexion can't disappear overnight. It'd be very hard for Alexion to have that many setbacks, whereas one false move in Avexis would be down 90% quite easily. So anyway, Gilead is, again, similarly very not risky. Regeneron is not as well either. So these three big longs are not that risky at all. But Avexis, of course, is, and I'm looking forward to Avexis's success. I think that stock is poised to go up threefold or maybe fivefold, but it is very, very, very risky. The hemophilia companies, I think, are all doing really well. Spark, Unicure, and Sangamo, and I don't think anything changed at the recent hemophilia conference. And as usual, I'm looking for new longs. I think Macrogenics could be a really interesting one. Back to the long list, Alnylam is pretty interesting. Versarchus is pretty interesting. Global Blood is really interesting. That could be a good long. So there's a lot of potentials out there, but I still want to be careful and thoughtful. And I do always think it makes sense to hold cash. Most beginners, including myself many years ago, make mistakes having too much leverage and having too much exposure, and cash is king. And should always, some of the greatest investors ever always keep as much cash as possible. If you think of someone like Baupost's fund manager Seth Klarman or Buffett or others, cash is really the place to be most of the time while you wait for huge opportunities. When huge opportunities exist, almost nobody has cash in times like 2008 and so forth. So you'll regret it when you have a leveraged portfolio and you're trying to invest in special situations in a time like 2008. Anyway, on the short side, I'm learning a little bit of the tech world with Weibo and Tableau. I have our secret short, of course. I have Snap and Twitter, which seem overvalued to me. Ironwood, I think this could be a 3-4% position. I just have to do a little bit more homework, and I'll feel better about that. Sihuan is I'm trying to spend more time looking at Asian stocks, so that's one that I thought was pretty overvalued. And I've talked a lot about these companies. Two of them have a new launch, and two of them I think are just overvalued. And then Neurotrope, which I basically think is a scam, is the biggest short. This has a high cost of RO, so just keep that in mind. Portfolio is about market neutral, about 48% invested, and up 6% year to date, even though the average gross is probably around 30%. So really happy that the performance kind of keeps going. It was a very quiet week in general. Not much in the news world. Celgene and BeiGene had a really interesting deal. I'm sure you can read up about it yourself. Again, you might ask yourself why so many companies want a PD-1 drug. I think it is a little foolish that everyone wants a PD-1 antibody. This will be probably the first drug class ever where there's probably like 10 FDA-approved antibodies. It's a really bizarre sort of situation. And it'll inevitably be sort of a price war, so we'll see what happens there. Stada has a really weird situation with a buyout. It's kind of an interesting merger arb situation. I'd encourage you to sort of take a look at that. Dupixent is the Regeneron product, which is starting to pick up, and I'm glad that after 2 kind of flattish weeks, sales are now growing very rapidly. New England Journal published the Elagolix phase 3. The data look really good. I bet that'll be a blockbuster. That's for endometriosis. Amazon and Dish are supposed to be doing something together. We'll see what it is. They're not merging, but they could do some kind of wireless or telephony play. It'll be really interesting to see what happens there. It's amazing to see how innovative Amazon is. Jawbone shut down. I thought that was kind of interesting. We're seeing some of the venture capitalism excesses. Dr. Topol, Eric Topol, wrote a nice editorial in the Wall Street Journal, and it kind of reminded me. I saw that a company called Push Doctor raised a Series B, relatively good size. And the concept is that a lot of healthcare costs can be cut through technology. That's what Dr. Topol mentioned, and I think that's true. And companies like Push Doctor and others will probably be the big successes over the next decade as we try to cut a $3 trillion industry that has a ton of waste, the U.S. healthcare system. And even saving 10% of that will make some tech companies very, very successful. So we'll see kind of what happens out of there. All right, I got a bunch of questions. Masters asks if I know anything about the singularity or believe in Kurzweil's concept of the singularity. I have to say, as a child, this inspired me greatly. I still have all my old Kurzweil books. I obviously think Kurzweil, being a futurist and a bit of a science fiction writer, gets it a bit wrong, I should say. I think technology does progress in singularity-like paradigms, but they're sort of enclosed paradigms, in that singularities are kind of in their own sphere, and they don't jump to things outside of that own enclosed sphere. So I don't know if that makes a lot of sense, but a good example is computing power that's sort of reached singularity-like proportions, but there's only so many applications of that computing power. So there's a ton of different sort of issues that one has to think about, and the concept of singularity makes sense. That there's a point of kind of exponentially increasing return, but it doesn't really mean that we're going to transcend humanity tomorrow. Brian asked me about Acorda. I don't think it's overvalued or undervalued. It's sort of hard. If I had to guess, I'd say it's overvalued. Sure, Matt. Josh asked me if I've given up on Twitter. Twitter is content with having a very censor-driven platform. It's a very left-leaning company. I'm a right-leaning kind of person, and if Twitter wants to be that way, that's up to Twitter. Facebook is a little more open of a platform, and I noticed that one of my favorite people on the internet, Mark Andreessen, canceled his own Twitter. I think he felt he was wasting time on it, and I think he's right. So it's almost a blessing in disguise that Twitter's banned me, because I have more time to do the things that I want to do instead of sort of being a slave to social media. Josh asks about the 21st Century Cures Act. I think that the FDA does what it wants. A lot of people don't appreciate that the FDA isn't really a political organization, and that the people that have been at the FDA for a long time, that don't leave the FDA with every kind of change in politics, those are the people like Margaret Hamburg, not Margaret Hamburg, I'm sorry, people like Shannon Woodcock and Bob Temple, who have been at the FDA forever. Those are the people that really make the decisions at the FDA, and all of these acts and changes politically don't really mean anything. Florian asked me about precious metals. I think that you should sell precious metals. I don't think it's because they don't pay a dividend. I don't think it's because they don't grow. I just think that commodities are sort of just that, and they're stores of value. They're useful as hedges to a certain extent, but they shouldn't encompass a large part of your wealth in my eyes. Cash is good enough, especially if it's something like euro or dollars. I wouldn't hold all one currency, so I think there is something to be said for being currency diversified, and if that might mean owning some Bitcoin or owning some gold, some commodities, but I think they're stores of value, not investments. So sort of think about it that way, and they're risky stores of value in many ways, right? They're very volatile stores of value relative to cash and things like that. Jackson asked a great question. How long is it reasonable to be short? What if the market isn't seeing what you're seeing? And I think this sort of equally applies to long. And it's one of the hardest questions in investing. So there's no easy, simple answer. I think that one of the things that a lot of people like to follow, and I think it's a relatively good way to think about it, is that you should have a prospective thesis, the a priori defined thesis. So you have a set out thesis where you have a specific sort of plan in mind for your investment, and that so long as your plan is sort of following suit, you stay in your investment. If your plans change, or your thesis is borne out incorrectly, it makes sense to exit your investment. The other opportunity is, just being intellectually honest. If the market's going against your position, chances are you're missing something, and it makes sense to reevaluate, especially as a younger investor. Setting a stop loss limit is not a bad idea. There's something called a time loss limit as well, where after a certain amount of time you exit your position regardless. I think that's not a bad idea. I think as you get more experience, you'll have a better appreciation for what to do and when to do it. But this is one of the most dogged, difficult questions to answer for beginners and experienced investors alike. How long does it take for your investment to bear fruit? I think that portfolio so-called spring cleaning does make sense, that every 6 or 12 months you or even 3 months, you dust off kind of the positions that aren't working for you and you move on. But if you feel really, really confident in your investments and nothing's changed in your hypothesis, continuing to keep your investment isn't a bad thing. I sometimes like to increase my investment as time goes on if my hypothesis has not been changed. So I think that sort of makes sense. But anyway, we can talk more about that at your convenience. Why didn't the prior owners of Daraprim increase the price of Daraprim? Great question, David. They actually did. Daraprim was even cheaper than it is now. I still think Daraprim is very cheap compared to similar orphan drugs like Soliris or Naglazyme or whatever, because it's an acute care drug that you only need once. So it really is cheap compared to chronic drugs that you need for the rest of your life. So those prices did go up, but the reality is there's so many pharmaceuticals, 6,300 U.S. pharmaceutical products, that not every company can understand whether all of their products are priced appropriately, which is it's somewhat surprising. It's almost like going to a restaurant and seeing on the menu, an entree for $20, let's say a pasta entree, then a chicken entree for $20, and then a turkey entree for $1. And imagine if every restaurant in America had just a price that they didn't sort of look at the menu and realize that their prices were off. And this is sort of the way it is in pharmaceuticals, which is why I've done the Daraprim type price increase about 7 different times. I only got into a lot of hot water when I did it because some politicians maybe noticed it this time around, and maybe this time around I was less, more proud of it, or more, wanting to sort of tell people why it's sort of a healthy, natural thing for prices to go up to their normal price. So one of the things that you learn about in investing is this concept of price discovery, that prices don't get re-rated instantly, even by relatively efficient markets. So the people that originally had Daraprim actually raised the price of Daraprim by 10-fold or 20-fold, and we raised it by 50-fold on top of those already. So you can see how inefficient it was priced. And I still think it's priced below kind of where it should be priced. So it is, hopefully an answer to your question there. Do you include stock-based compensation and discounted cash flows? This is a really good question from Karan, and I think it's our last question. It really depends. I think that using Black-Scholes to calculate the value of options is really difficult. If it's restricted stock, it's a lot easier But even then, it implies that the current value of the stock is fair. So if a company is really overvalued, let's say, and they use stock-based compensation, I'm not sure that cost is correct. So you have to look at it with and without stock-based compensation, I think. So it really is company specific, but it's very complex. And it's one of the hardest things, I'd say, in my method of forecasting, is really understanding what's happening to stock-based comp in some of these companies is very difficult. And just using the GAAP accounting is really misleading and very difficult to sort of ascertain whether or not the company's truly framing its costs correctly. And that, again, it's no fault of the company. It's simply GAAP accounting. But you have to sort of make your own decision on that. And for some tech companies especially, it's really obscure and difficult. For large companies, SBC is usually such a small percentage of costs that it's really irrelevant. But also depends on that company's compensation philosophy. So it's really tricky to sort of understand it completely. And I'm glad you asked. All right, we're almost done here. What am I reading? I haven't been reading a lot because I have, as I mentioned, a prior engagement. But I've been reading this book while I have been busy with that engagement. It's called Medicinal Chemistry, The Modern Drug Discovery Process. Amazingly, about half the book has no chemistry in it, which is a little frustrating. It's more of a drug discovery book. It inspired me. It's a relatively good book, so it kind of inspired me to maybe think about creating a multidisciplinary course called Drug Discovery that encompasses medicinal chemistry, pharmacokinetics, and sort of research methods in drug discovery. And I'm thinking about that. If there's interest in that, I can kind of record a YouTube series about it, but basically the concept would be drug discovery from scratch, and it would teach its listeners the way to basically from scratch how to discover drugs and assay development and things like that. A real pro pharmaceutical professional's perspective, and it sort of would traverse chemistry, biology, and biochemistry and research the way a pharmaceutical company would do it. So if there's a lot of interest in that, email me, and I think I'd be very happy to sort of show you the way you could create a drug from scratch and patent a drug from scratch. I even thought what would be fun is over the course of the course that we actually would create a medicine ourselves and patent it ourselves, and that would be kind of fun to do. The other thing that I read is on Reddit. There's in the entrepreneur subreddit, there's this really cool little thing, and if you're an entrepreneur, I suggest you close this window and go read it as soon as you can. It's called How Startups Such as Dropbox, Airbnb, Groupon, and others got their first customers. Now, Groupon isn't such a successful company, but the point being that all of these companies have these really unique stories about how they got their first critical mass. And I think most people ask themselves, how do you get critical mass in a startup? Here's Tinder, Airbnb, Groupon, Foursquare, Quora, Reddit, Dropbox, all these companies, and how they... this was submitted 2 years ago, interestingly, but it's still a really good read. I've really enjoyed it. If you haven't read it yet, take a look. I think a lot of people think about the idea is the important thing in a tech business, and it really is totally untrue. It's really about the execution. The idea is practically irrelevant. If you can execute, there's always an opportunity for you to succeed. The people say, "Oh, I have this great idea for a startup." Well, that's nice. The real problem is actually making it work. And there are some really silly business ideas that are actually good businesses based on their execution. And there's some really great business ideas that are terrible businesses based on poor execution. So, it really is about execution. And some of those stories are really good for learning a little bit about what it takes to be an entrepreneur and the dedication and effort it takes. And I think some of that comes naturally to great entrepreneurs. But read it and you'll see what I mean. All right, folks, thank you so much. That's really it. You can always email me at martin@thotpatrol.com, thotpatrol.com. You can sign up for my new software company called Godel at godel.systems. You have to include your LinkedIn so we know you're a real person. See you next week. Thanks for everything.